People love the idea of passive real estate investing. Put in your money, collect free money. It's simple, right? Well, it's not really how it works. I personally have made over $30 million with real estate. And today I'm pulling back the curtain on how these deals really work. I'll tell you what no one tells you up front and how to spot the difference between being a solid investment and really just a sales pitch. Passive real estate investment sounds easy until the deal gets delayed, the operator goes silent, your preferred returns never show up, the building department gets involved, the rents don't go as planned. There's so many different things that can happen. But here are some common myths passive investors believe going in. They believe that they just simply show up, sign some documents, everything's going to go perfectly. There's not going to be any hiccups. Returns are going to flow. Tenants are going to move out on schedule. They're not going to do any damage. All of these are the kinds of things that operators have to deal with all the time. Now, when we put that into a spreadsheet, obviously we have to assume a lot of things. But it's when you really get to the nuts and bolts of how the deal goes that you really see the experience that a person has. And this often leads to a lot of surprises for passive investors once they've wired the money, because the reality of owning and operating property begins to sink in. And without great communication from the operator or the general partner, you're going to see these things magnified because your experience is going to be based on what the pro forma says and what you're expecting versus the actual reality of what happens day to day in operating properties. Let me just tell you that passive investing oftentimes is more of a marketing term than an actual reality. The goal is for the general partner, someone like myself, and the limited partners, someone who is just wanting to invest money, coming together and allowing the limited partners to act passively because they don't have to show up and mow the grass. They're not doing the market studies and moving tenants in and moving tenants out and collecting past due rents and all of those things. So ideally, it should be passive. But that's really where experience is going to tell you whether or not you're involved in a passive investment. And oftentimes, by the time you figure that out, it's too late because you've already sent your money to the investment team. And now you're starting to see these cracks that I call them because they aren't able to pull off what they've marketed that they can do. In many syndications, in fact, I think all syndications, the investors don't actually own the property. They own shares in a limited liability company or an LLC that keeps them outside of the deal. They really don't control anything. They have the ability to control when they put their money in, but after that, they really aren't in control of the asset at all. They have limited liquidity, and they do have a very real risk of losing their money. The benefit is they don't have a risk of signing on the loans. They don't have a risk of being liable to banks. They don't have a risk of actually doing the work, but they still have a very real risk of losing that investment. In most passive deals, there's three entities. There's the operating company, there's the general partners, and there's the limited liability company. And the operating company is the one that is doing all of the work. The general partners are the ones that have found the deal. They have the expertise. They're signing for the loans. They're doing all of the things that are necessary to bring the investment to the public. And then there's the limited liability partners or the LLC that has the limited liability members in it. They are limited in everything, in every aspect. And that's really who is funding most of the deal, but they're in the least control of the deal, which is why it is so important that you actually know who owns it, who operates it, and what the overall goal of the investment is, so that at the end of the day, you understand how you are vetted or how you are invested in this particular deal. Let's go into some of the red flags that investors should be looking for when they're reading through the offering memorandum. I'll give you a couple of them, but there's a multitude of them. Anybody that's underwriting a cap rate that is equal to or less than the cap rate that they're purchasing the property at. Anyone that is assuming that they can be in and out of a deal in 24 months probably needs to be explored further as to why that is in there. Anyone that is showing an offering memorandum that is showing very high returns, incredibly high returns, you've got to really understand, why is that such a unicorn? What have they found that is going to give them 30% returns on the IRR? What are they really accomplishing? Anybody that says that they've never lost money is definitely somebody that you should be leery of, because let's just face it, everybody at some point loses money, whether that's just money falling out of your pocket, losing your wallet. Doing investment deals is no different. You just have to understand that by being a part of this conglomeration of GP/LP operator, who is really in control and what is their experience level to mitigate the elements of risk that are everywhere in the market. And these are the kinds of things that you really have to watch for. And if anybody says that they haven't lost any money, then you really, really should question that. The other thing that I think is a huge red flag is if the GP team isn't putting money in themselves. I always structure my deals that I put in 5% of the total capital needed. So if we're raising $10 million, I'm going to put in $500,000 of my own money. This gives me skin in the game. I mean, just think about this. The project is not going well. The bank is upset because we're not achieving the rents. Interest rates are changing. Remodel is taking longer. The construction is taking longer. Expenses are higher. If I don't have any money in the game, if I'm not at risk myself for anything other than my work, I'm probably going to stop working on this project, go find another project, get another group of people, and let this project just kind of fall apart. So you really have to make sure that the people that you're working with have money in the game as well. The other thing I would be very leery of is somebody that has a new deal every single month, right? There are deals that we pass on because they're just not going to work at the price that they have, the location. There's a lot of markets out there that aren't great markets. There's a lot of markets out there that aren't going to provide the kind of returns. They're not going to get preferential lending. There's a lot of markets out there that need to be very seriously considered before an investment is made. And so if you're not working with someone that has a pipeline that brings deals into them and they've got a lot of them that they pass on, they are grabbing every single thing and they're pencil whipping that spreadsheet to make it say that every deal is a good deal. And that should scare you enough that you don't invest with them. You know, just last week, I had 5 deals come into my inbox that I didn't even consider because very quickly I was able to deduce that they weren't either in markets that I felt were good ones or were overpriced. They required really more work than what was being allocated in the remodel portion of the deal to get the kind of returns from the rents. And so you really have to look at the deal and understand it a little bit better before you just go investing in it. Let's talk about how to approach passive investing deals the right way. Good passive real estate deals do exist, but they require a lot of due diligence. Due diligence on the operator, due diligence on the assumptions, due diligence on the structure itself, exploring the marketplace that this deal is in, and exploring the time horizon that the operator wants to control the deal in order to get the returns that everyone's looking for. Now, here's some things that every investor should ask before they ever invest a dollar into any deals. The first question you should ask is, what are my goals? What am I really trying to get my money to do while I do my day job? What am I wanting out of this? Am I wanting cash flow? Am I wanting tax savings? Am I wanting to build long-term wealth? Oftentimes people chase the wrong things. You know, I have a lot of investors, first-time investors that I talk with, that they immediately come to me and they say, I want cash flow. The thing is, they have $100,000. And so I immediately ask them, can you live on a 6% cash on cash return from the amount of money that you have? Oftentimes the answer is no. Well, that means that you need to somehow figure out how to get more than $100,000, which means you may be looking for initial investments that are tax advantaged that are allowing you to keep more of your money to make future investments. You may be looking at deals that are ground up development deals because they have a higher IRR and they're able to multiply your money faster so that you can go from a point of having $100,000 to a point of having $1 million, where a cash on cash investment return of 6% actually starts to make sense. So you need to understand where you are as an investor in your life cycle and what you want out of these deals. That will keep you from chasing the wrong deals with the wrong operators. Let's talk about what your due diligence checklist is for vetting the operators and the sponsors of a deal. You really need to have a robust checklist. And if you'll click in the notes below, you'll see I've provided a checklist for you where you can actually start to break down what are the questions that you need to be asking of a sponsor? What are you pulling out for information that is important to you out of the PPM, which is the private placement memorandum that explains the deal? Because if you're not properly vetting the deal or the sponsor, then you're kind of gambling on whether or not this person has the experience and this deal is going to meet the criteria that you have. It's funny. I have over $70 million worth of investor capital that we work with on a consistent basis. And out of that, I've only had 3 people actually come and see me, want to spend time with me, see my deal, see my operation, see whether or not I have a legitimate business, which to me is quite frightening. It means that a lot of people are just trusting what they see on the internet, what they read in the PPMs, instead of actually digging in on who the sponsor is, what they're doing, and how they're actually running their operation. Because that will tell you a lot about what the success rate of the deal is just by getting face-to-face with the sponsor, just by getting face-to-face with the operating company to see what they're really going to be able to provide you with. So let's talk about one of the deals that we did. This was a deal that had some good, some bad in it. It was a multi-tenant industrial project that we developed here in Boise, Idaho. And we bought the property. We ran into some delays. Interest rates began to rise. We were on the tail end of COVID. We still had some delays and some lag in what we were getting for materials as we were building the project. But we were very sure of our market and we'd done our due diligence on the market. So when it came time to handle the delays, some of the cost overruns that were happening, some of the other things that we were experiencing, we were actually able to achieve a better than we had anticipated rent from our tenants, which was able to overcome a lot of the issues that we had with the build job on the property itself. And that's what's important. It's not that everything goes perfectly, but it's, do you have an answer when things don't? Or is your spreadsheet stretched so thin that everything has to go perfect? The rents have to come in right on time. The bank note has to be at this point or better or lower so that you don't have any room in there to overcome some of the difficulties that will come your way. And that's really what makes it work. We were able to do that deal. It took us about 12 months longer than we had anticipated, but our investors were still able to make a 20% return. A 20% IRR is a fantastic return, especially when you combine it with the other benefits that real estate does provide you. We were able to make our investors the kind of returns that we had promised, even though the whole project had difficulties with it. And this is the difference that experience brings to the table that helps investors protect their hard-earned capital that they are deploying in the search for returns that make sense. The real value in passive investing isn't doing nothing. It isn't even doing everything perfectly. It's knowing when to say no to something and not making that investment. That's really where you have vetted out a lot of the opportunities for things to go wrong, and you've stuck with your core values as far as what is going to be the best investment for you as an investor. When people think about passive real estate investing, everybody thinks it's something they can do. But if you're a bit of a control freak, if you want to have all of the answers all of the time, passive investing probably isn't a good fit for you because there's too many things that are beyond your control. If you're the kind of investor who is looking to get in and get out 24 to 36 months, passive investing probably isn't the right vehicle for you either. These deals can change with interest rates going up, with rents not appreciating like we had initially thought, All of these things can change the time horizon. And if you're someone that needs your money back in 24 months or 36 months in order for things to work in your life, it's probably not the best idea for you to do. But if you're the kind of person who is busy with your day job, you're making money, you're trying to find ways to defer that tax burden, to defer income, to build real generational wealth, and you're a patient person, you're able to do the proper due diligence up front, make sure that you know who you're investing with, and then give them the time and the runway for them to do the kinds of things that need to be done. There's a lot of great syndicators out there that will put together a PPM that says that this is somewhere between a 5 and a 7 year deal. Having 2 additional years is really important, because if you're selling just because the time has expired, it doesn't mean that you're selling at the best possible time. The last 12 months have been a classic example of, if I had to sell on my side as a general partner and an operator, I would not have been able to make the best returns for my investors. However, as rents have continued to appreciate, we are headed into a time where everyone believes we're going to be getting lower interest rates, which means we're going to be getting higher prices and lower cap rates. Then we are headed into a position where, by hanging on for an additional year, maybe even 2, we're going to be able to provide the right investing experience for our passive investors. And that's really what's going to be the difference between a deal and a good deal. If you're the kind of person that values someone else's expertise, you'll probably be a good fit for a passive investor, because you'll understand that you are looking for someone else that is an expert in an area that you're not. And you vetted them to the point that you understand that they are very good at what they do. They have the track record and can pull off the kind of experience that you're looking for. That's going to be a great partnership for you guys as the operator and the passive investor, because you've come to a place where you're flexible, you understand that you're working with a professional, and you're able to let them do what they need to do to make your investment the best it can be. The other thing is, you have to really do your due diligence on the sponsor and the operating company, because once you understand that you have the ability to partner with someone who has years of experience, a proven track record, the connections that are going to get the kind of results that you're looking for through banking, through sales, with all the other things that go into a deal, you're going to be in a great position to succeed with that coupling and partnership, because you have understood that you have done the due diligence to find the operator that is best fitting your needs at the time. And then you've made an investment that 5 to 7 years from now is going to have the kind of paydays you're looking for. One of the first things that I would advise you to do, if you feel like you fit the role of a passive investor, is to get on the phone, to book a call with the sponsor. We take calls all the time. We talk with people about what we have available, what investments are on our horizon. And oftentimes we will recommend that a person maybe not invest with us at this time, but I'd love to have a call with you if you feel like maybe you would be a fit. We could work together, because that's the first step, is sitting down, having a conversation, making sure that we're in alignment on our goals, making sure that we're in alignment on our objectives and our time horizons, all of those kinds of things. Go to our website, connect with us. Let's get on a call and find out if our goals are in alignment and if this would be a great partnership for us to pursue. In 2008, I lost everything. And that taught me a lot of lessons on what I structure now and how I do things different. And if you'd like to know more about what happened in 2008 to me, you can watch that video next, and it'll give you more insight on what lessons I've learned and how things are structured differently now to prevent myself, and more importantly, my investors, from repeating histories. And oftentimes we will recommend that a person maybe not invest with us at this time, but I'd love to have a call with you if you feel like maybe you would be a fit. We could work together, because that's the first step, is sitting down, having a conversation, making sure that we're in alignment on our goals, making sure that we're in alignment on our objectives and our time horizons, all of those kinds of things. Go to our website, connect with us. Let's get on a call and find out if our goals are in alignment and if this would be a great partnership for us to pursue. In 2008, I lost everything. And that taught me a lot of lessons on what I structure now and how I do things different. And if you'd like to know more about what happened in 2008 to me, you can watch that video next, and it'll give you more insight on what lessons I've learned and how things are structured differently now to prevent myself and, more importantly, my investors from repeating history.